Hello guys, welcome to today's lesson. It's Dave Tech here, and today we are going to be looking at a very important. Okay, so we'll be looking at a very important concept, which is candlesticks, right? So what you will learn from this video is everything you need to know about candlesticks in technical analysis. So let's get into it. Now, on technical analysis, we have two kinds of candlesticks. We have the bullish and the bearish candlesticks. These are the primary or the basic candlesticks we have on technical analysis. I'll start with the bullish candlesticks before we get into the bearish candlesticks. Now, for the bullish candlesticks, this is bullish because it means buy. It is a demand zone when we have buyers in the markets or demand in the markets. Normal economics, demand and supply, but this is for demand now. Now, what this means is at the time of these candlesticks, it opens from this lowest point, very important, from this lowest point. Then sellers came into the market, pushed it down to this point, right? Then buyers came back into the market, pushed it all the way top to this highest point. Then it closed at this point. I'll take that one more time. What this means is it opens from these points. Sellers pushed it to this lowest point. Then buyers came back into the market, bought all the way top to this highest point. Then it came back and sellers pushed a bit, then it closed at this point. The reason this candlestick is a bullish candlestick is because we had more buyers than sellers. So automatically it makes this candlestick a bullish candlestick. So now let's talk about the bearish candlestick, right? So now the bearish candlestick is direct opposite of the bullish candlestick. For the bearish candlestick, it opened from the top. Remember, for the bullish, it starts from down to up, while for the bearish is from top to bottom. So it opens from this top, buyers pushed it up a bit, then sellers take over, took it down to this lowest point, then buyers were able to push it a bit top to this point, at this point, right? So I'll take that one more time. It opened from here, buyers pushed it a bit, sellers came back, took it down to this lowest point, then managed to come up a bit and closed at this point. The reason is bearish because it has more sellers than buyers. For bullish, it has more buyers than sellers. So this is just the basics. Then I'm going to open a real chart so we'll see what exactly that means, what it looks like on a real chart. But before then, we'll go on a short break. When we get done, we'll go on a live chat. Alright, welcome back guys. So earlier when I was talking about candlesticks, now this is a real chart, a live chart. This is gold on the 4-hour time frame. So some persons might not really understand what time frame is, but time frame simply means this candlestick you see here, it took 4 hours for this candlestick to be formed. Each of these candlesticks you see on the screen, it took each of them 4 hours to be formed. Every candlestick is here. Now this is 4 hours. We have different time frames. These are different time frame. There is 1 hour, there is 2 hours, because trading is very subjective. So what that means is different traders trade differently, and each traders have the kind of time frame they trade with, right? So for me, I mostly use the daily 4 hours, 15 and 30 minutes time frame for most of my trading, because there are some other traders that use 1 hour, 2 hours. So now let's look at this. This is daily time frame. Okay, this is gold on the daily time frame. What this means is that each of these candlesticks here represents 1 day. Very important. Each of these candlesticks here represent 24 hours, which is 1 day. So this candlestick, it took 24 hours for this candlestick to form. It took 24 hours for this candlestick to form. Right. So it took 24 hours for each of these candlesticks to form. Now let's move back to let's go to the 30 minutes time frame and see. All right, so this is the 30 minutes time frame. So each of these candlestick here took 30 minutes. Each of them represent 30 minutes, 30 minutes, 30 minutes, 30 minutes, 30 minutes. Every candlestick here represent 30 minutes. So I hope you understand what candlestick is. Okay. So then let's go back to the 4 hour time frame. Alright, so this is the 4 hour time frame. Now this is what I was trying to explain in the previous video. Now as at the time of this candlestick in the last 4 hours, it opened here. This candlestick opened at this point. Buyers came into the market, pushed it up to this point. Sellers took over, brought it down back to this point here. Then buyers were able to push it a bit. Now this is where it is currently, right? So this is where it is currently. For this candlestick here, this candlestick, as at the time of this candlestick, it opened here. Now if you notice, this is a bullish candlestick. The last one we just analyzed is a bearish candlestick. Now for the bullish candlestick, it's opened here, down here. Sellers managed to push it down to this point. This is where the week at this week, buyers came back into the market, bought all the way top to this point. Then sellers were able to push it down before the close of this candlestick. Then this candlestick opened at this point. This is a bearish candlestick now from up. Buyers came into the market, took it up all the way to this point. Sellers came back into the market, pushed it down to this point. Then it closed at this point. So this is what I was trying to illustrate in the last place. I don't know if this make any sense, but yeah, we've come to the end of these candlesticks. So in next video you will see me will be on technical analysis.